5 things, 5 specific financial practices that I kept entirely to myself for most of my working life. Not because I was secretive by nature, not because I was protecting competitive advantage in some narrow sense, because I watched what happened to men who described these practices publicly before the practices had produced undeniable results, and what happened was almost always the same. The people who heard the descriptions immediately began telling the man why the practices were wrong or risky or contrary to how things were done, or simply not going to work for someone in his specific situation. And the man, because he was describing a practice rather than presenting a proven result, had no defense against the critique that did not sound like defensiveness. So the critique entered his thinking. The certainty that the practice required to sustain it was diluted. And in several cases I watched personally, the practice was abandoned before it had produced the result that would have made the abandonment obviously costly. The secrecy was not about hiding, it was about protecting. There is a difference, and I will describe it precisely. But first I want to tell you what the 5 practices are, because they are specific enough that most people, when they hear them clearly, will immediately recognize at least one they have been doing without knowing it had a name, and at least one they have been avoiding without knowing it was the thing they most needed. I am Henry Ford. I built the Ford Motor Company from a single engine in a shed. By the standards of my era, I became one of the wealthiest men on earth. I did not accomplish this through any unusual intelligence or any fortunate circumstances that were unavailable to other men. I accomplished it through 5 specific financial practices that I applied consistently across the years when the outcomes were not yet visible, and held to through the years when they were producing results that attracted the attention of men who wanted to know how I was doing what I was doing. I am going to describe all 5 in full, with the specific reasoning behind each one and the specific way each one works in practice, so that by the end of this message, you have not 5 abstract ideas, but 5 concrete practices that you can apply starting tomorrow in whatever financial situation you are currently in. Listen to this every day. The man who hears these 5 practices once understands them. The man who hears them 30 times has started to apply them. And the difference between understanding and applying is the only difference that matters. The first practice is one I called production before consumption. I did not call it that publicly. I did not call it anything publicly. I thought of it in those terms privately, and I applied it in a specific way that I want to describe in enough detail that you can apply the same specific version rather than a vague approximation of it. The standard financial behavior of most men, including most successful men, is to consume at the level that the current income permits. When the income rises, the consumption rises with it. The life expands to match the income. This is so natural that most men do not experience it as a choice. It simply happens. The raise arrives. The expenses find a way to absorb it. The financial position at the end of the year is similar to the financial position at the beginning, larger in absolute terms because the income is larger, but similar in structure because the consumption has risen proportionally. Production before consumption works differently. It holds the consumption constant when the income rises and directs the difference, the amount by which the income rose above the previous level, entirely toward production, not toward saving in the abstract, toward a specific productive activity, a piece of equipment, a supply arrangement, a small additional productive capacity that, once established, generates its own output without requiring a corresponding increase in consumption to sustain it. When I was developing the production systems at Highland Park in the years before the assembly line reached full operation, every improvement in the efficiency of the operation reduced the cost per unit of vehicle produced. I did not take that reduction in cost as an improvement in the comfort of the operation or as a signal that spending in other areas could increase. I took it as capital for the next efficiency improvement. The production got cheaper. The saving from the cheaper production went into the next piece of equipment that made production cheaper still. The cycle compounded in a direction that continuous consumption of the savings could not have approached. The practical version of this for your own financial life is not about manufacturing plants. It is about the specific habit of treating any increase in income as capital for productive activity rather than as permission for expanded consumption. The raise does not mean a larger apartment. It means a specific investment in a specific productive capacity that generates output. The savings from a reduced expense do not mean more spending elsewhere. They mean capital for the next productive investment. The reason this practice must be kept in silence, particularly in its early stages, is that the people around you who observe the income rising without the consumption rising will have opinions about this. The opinions will not be hostile. They will be well-meaning. They will take the form of reminders that you deserve to enjoy the results of your work, that life is short, that money is meant to be used, that the security you are building through conservative consumption is already sufficient, and that living better now is the reasonable response to having earned more. These opinions are not wrong as general philosophical positions. They are destructive to the specific practice of production before consumption if they are received before the practice has produced results visible enough to stand against the argument. Keep the practice private, not forever, until the results speak for themselves. The results speak for themselves when the productive investments you have made from the savings of non-expanded consumption begin generating their own output. At that point, the argument for enjoying the raise, rather than investing it, has been answered not by a counter-argument, but by a demonstrated result. Demonstrated results are not vulnerable to the well-meaning opinions of people who mean well, but have never applied the practice themselves. I will tell you honestly that in my own life, this practice was under pressure from people I loved and respected. Clara understood the direction, but there were years when the gap between what our income permitted and what we were actually spending was visible enough to others that the questions arrived. Why not more comfortable circumstances now? Why the ongoing restraint when the resources were there? The answers I gave were honest but partial. I described the direction without fully describing the specific mechanism of compounding productive investment that made the restraint rational. And the partial description was enough to sustain the questions without fully resolving them. What I could not say, and what I can say now, is that the restraint was not really restraint in the end. It was investment. Every year of not expanding consumption to match expanded income was a year of compounding productive capacity, and compounding productive capacity grows faster than expanded consumption would have grown. The years of apparent restraint produced, in their cumulative result, a financial position that the years of matching consumption to income never could have reached. The second practice is one that I think about as the separation of production money from consumption money. Not two bank accounts necessarily, though that is one form it can take. Two completely separate mental categories, and the commitment to never moving money from the production category into the consumption category, regardless of the pressure to do so. Most people treat their money as a single pool that serves all purposes. When a need arises, the pool is drawn from. When an opportunity arises, the pool is drawn from. When an emergency arises, the pool is drawn from. The pool is managed as a unified resource, and its purpose shifts with whatever the current demand on it is. This produces a specific outcome that I observed consistently in the financial lives of men I knew. The money that was earmarked in intention for productive investment was continuously redirected to consumption demands before the investment had time to compound into something significant. The pool was managed with good intentions for production, but the consumption demands were immediate and the production opportunities were delayed, and the immediate always wins against the delayed when they draw from the same pool. The separation I maintained was not about discipline in the sense of resisting temptation. It was about structure. I made it structurally impossible to draw from the production pool for consumption purposes by ensuring that the two categories were not accessible through the same mechanism. Money designated for productive investment was committed to that investment before the consumption pool saw it. The consumption pool was what remained after the production allocation. Consumption was funded by what was left, not by what was available. This sounds straightforward, and it is straightforward once the structure is in place. The difficulty is in establishing the structure before the habit of drawing from a single pool has been replaced by the habit of separating before spending. The transition period, the period between deciding to implement the separation and the period when the separation has become automatic, is when most men who attempt this revert to the single pool. Because the commitment to production allocation before consumption allocation means that the consumption pool is smaller than the single pool was, and the smaller consumption pool creates the feeling of scarcity that the single pool did not produce, even when both contained the same total amount. The feeling of scarcity is not evidence of actual scarcity. It is the adjustment period between one structure and another. The man who has separated production money from consumption money and is managing a smaller consumption pool than he previously had access to will feel, for a period, as though he has less than before. He has the same total amount. He has structured it differently. And the different structure, because it produces a feeling rather than an objective condition, is one of the most practically difficult changes to sustain through the adjustment period. Sustain it. The adjustment period ends when the production pool begins generating its own output. At that point, the total available resources are growing from the production pool's output without requiring any additional reduction in the consumption pool. The feeling of scarcity was temporary. The compounding from the production pool is permanent, and the permanent compounding eventually produces a production pool large enough that its output alone exceeds the consumption requirements, which is the specific financial condition that constitutes independence rather than wage dependency. A man named Samuel, who worked with me in the early years of the company, came to me once with a question about money that I remember clearly because it illustrated the separation principle in a way that made the principle visible. Samuel had received a substantial sum from an inheritance. He wanted my advice on how to use it. I asked him one question before giving any advice. I asked him what proportion of the sum he had already committed to productive investment before he came to ask me about using it. He had committed none of it. The entire sum was in the single pool, available for any purpose, and he was asking what purpose to put it toward. I told him that the first thing to do was not to decide what to invest in. It was to separate the sum into two pools before either purpose had a claim on it. Take a specific percentage and commit it to production irrevocably before making any other decision about the remainder. Then manage the remainder however he wished. The irrevocable commitment to the production pool before any other claim was the practice, not the choice of investment. The structural separation that prevented the production pool from being available for consumption, regardless of what consumption demanded. Samuel followed this advice partially. He separated a smaller percentage than I had suggested because the full amount I suggested felt like more than the consumption pool could absorb. And that smaller percentage, invested in a specific business he understood well, grew over the following years into something that eventually produced output larger than the original inheritance. The percentage he had not committed to production was spent over the same years on consumption that produced nothing that persisted. He told me, later, that the regret was not painful about the consumed portion. What he regretted was the percentage he had not separated, not what he spent the remainder on. The specific percentage that could have been in the production pool and was not. Separate the pools. Do it before any other financial decision. And hold the separation structurally rather than through willpower, because willpower fails under pressure, and structure does not require willpower to sustain it. The third practice is one I kept the most private of the five, because it was the one most contrary to the conventional wisdom of the financial world as it was understood in my time. I thought of it as paying myself in productive capacity rather than in money, and the specific mechanism of it is the one that most clearly explains how the compounding of financial independence actually works at the deep level. When the Ford Motor Company was generating profits, the conventional expectation was that the profits would be distributed to shareholders, to the men who had invested in the company, to me as the largest owner. This expectation was reasonable, and the distributions that did occur were real and substantial. But a portion of the profit that I retained, larger than investors typically wanted retained, went not into my personal consumption, but into productive capacity, into machinery, into process improvements, into the capability to produce more at lower cost, into the infrastructure that made the next stage of production possible. I was paying myself in productive capacity rather than in money, and productive capacity compounds in a way that money does not. Money held as money maintains its value in the best case and loses value in the worst case. Money converted into productive capacity generates output. Output generates more money. More money, converted again into productive capacity, generates more output. The cycle compounds in a direction that holding the money as money never could. This practice made me wealthy in ways that the distributions I took as money did not. The distributions I took as money were spent on things that were consumed. The productive capacity I retained generated returns that continued compounding for years after the original investment. The compounding of productive capacity is what separates the people who become genuinely wealthy from the people who earn large amounts and remain in roughly the same structural financial position. The reason this must be kept private is the most practical of the five. Investors want distributions. The people who have put money into your productive activity want to see returns in the form of money rather than in the form of more productive capacity. This preference is rational from their position. They invested money and they want money returned. Your interest in converting the returns into more productive capacity rather than distributing them conflicts with their interest in receiving distributions. The conflict is manageable if the productive capacity you are building generates returns that eventually exceed what the distributions would have provided. But managing the conflict requires that it not be relitigated in every conversation with every stakeholder. And it cannot be relitigated in every conversation if it has been described publicly as the practice, because the description invites the conversation. Keep the practice quiet. Demonstrate it through results. When the productive capacity you retained rather than distributed is generating returns larger than the distributions would have been, the practice has justified itself in terms that stakeholders can accept. Before that point, describing the practice produces the debate that the private practice avoids. Here is the first exercise. It takes 30 minutes and surfaces something most people have never looked at directly. Write down every significant source of money that has come to you in the past 3 years. Every raise, every bonus, every unexpected sum, every return from anything you were involved in. For each one, write where the money went. Specifically, not in general categories but in specific terms. What did it purchase or fund or enable? Now, mark each destination with one of 3 letters. P for productive, if the money went somewhere that generates its own output. C for consumptive, if the money went to something that was used and is now gone. H for held, if the money is sitting as money without being directed at production. Count the amounts in each category. What percentage of the total financial resources that arrived to you in 3 years is now in the P category, in the C category, in the H category? For most people who do this exercise honestly, the P percentage is much smaller than they expected, and the C percentage is much larger. This is not a moral judgment. It is the natural result of the single pool structure and the consumption after income rises pattern. The exercise surfaces the structure that is currently operating in your financial life. Once you can see the structure clearly, you can make deliberate changes to it. Without seeing it clearly, you are making changes in the dark. The fourth practice is one that took me the longest to understand fully because it operates at a level of indirection that most immediate financial thinking does not reach. I thought of it as building the system before building the house. The house is the comfortable circumstances of life. The system is the productive infrastructure that generates the income to sustain the comfortable circumstances. Most people build the house first, and then try to build the system from whatever the comfortable circumstances leave available. The specific cost of building the house before the system is this. A house built before the system requires income to maintain it, which means the income must continue at the level that sustains the house, which means the decisions about income cannot be made freely because they are constrained by the house's requirements. A man whose comfortable circumstances require a specific income level cannot make the choices about his work and his building that would be available to a man whose comfortable circumstances are modest enough to be sustained by a smaller income. The house constrains the system building by constraining the income decisions. The man who builds the system before the house builds the productive infrastructure first, lives on what that infrastructure requires rather than on what comfort permits, and expands the comfortable circumstances only when the system is generating enough output that the expansion can be made without affecting the system's continued growth. This sequence produces the specific condition of independence. The house is owned outright. The system generates more than the house requires. The decisions about work and building are free, rather than constrained by the house's requirements. The man is not dependent on any particular income level, because the system generates the income, and the system belongs to him rather than to an employer. I will say honestly that this sequence was not natural for me in the early years. There were years in the development of the company when the circumstances of life were more modest than the scale of the operation suggested they needed to be, and the modesty was chosen deliberately and not without its own pressures. Clara was patient with this in ways that I did not always adequately acknowledge. The house we could have built earlier than we did. The comfortable circumstances that the income would have permitted were available earlier than we took them. The decision to build the system first was the right decision, and it was not a painless decision in the years when it was being made. What made it sustainable was not discipline exactly. It was the specific visibility of what the system was becoming. Each year that the productive capacity grew, the visible evidence of the system's development was more available than it had been the year before. The deferred house was not a permanent sacrifice. It was a timed decision with a visible end point. When the system was large enough and stable enough that its output could sustain the house without constraining the system's continued growth, the house could be built from the system's output rather than from consumed income. And the house built from the system's output rather than from consumed income is a house that does not constrain the system's continued growth, because the system is already large enough that the house's requirements are a small fraction of the system's output. Build the system before the house. Live on what the system requires while the system is being built. Build the house when the system is generating enough that the house's requirements are a fraction of the output rather than the ceiling of the income. The fifth practice is the one I considered most purely a secret, in the sense that I never described it to anyone and rarely acknowledged it even in my private thinking until the later years, when the results it had produced were visible, enough that I could examine what had actually happened. I thought of it as the practice of letting the work compound without knowing it. Every man who has built something has had the experience of looking back at a decision made years earlier and understanding, from the vantage of where the decision led, that the decision was more important than it had seemed at the time. The decision that appeared to be a small operational choice, a specific way of doing something, a specific relationship maintained, a specific practice held to, turned out to have been a structural choice that compounded into something much larger than its original scale suggested. The practice of letting the work compound without knowing it is not the same as making good decisions. It is the specific habit of not prematurely harvesting the returns from building work to fund consumption. Most men who are building something successfully find that the building begins to produce returns that are available for harvesting, and the temptation to harvest those returns, to take the profit from the building into the comfortable circumstances of life, is both natural and partially self-defeating. It is natural because the building has been work, and the work produces a return, and the return should benefit the man who did the work. It is partially self-defeating because the return harvested from the building is return that does not compound further. Compounding requires that the return not be harvested. It requires that the return remain in the building, generating further output, until the building has grown to the point where the harvested portion of an expanded output is larger than the full harvest of the original output would have been. This is the mathematical fact of compounding that everyone knows in the abstract and almost no one applies in the specific. The specific application requires leaving returns in the building during the period when harvesting them would be immediately rewarding and when the people around you expect you to harvest them. It requires the practice of allowing the building to produce returns that you do not immediately take, because you understand that the unharvested returns compound into a larger future harvest than the immediate harvest would have produced. The reason this is the practice I kept most private is that it produces the most visible surface of apparent wealth without the corresponding apparent wealth. A man whose building is compounding without harvest looks, from the outside, like a man of significant resources, who is living well below those resources. This appearance is interpreted by most observers as either irrational restraint or hidden difficulty. Neither interpretation is accurate. The accurate description is that the man is managing the compounding of productive returns rather than harvesting them, and that the compounding will produce, at the point of harvest, an amount that the continuous harvest would never have approached. Here is the second exercise. It applies the compounding principle in its most practical form to your current situation. Identify the most significant productive activity in your current financial life, the business, the investment, the side operation, whatever is generating the most productive return relative to your involvement. Now calculate honestly what you have harvested from this activity in the past year. Write the number. Then calculate what the activity is currently worth as a going concern, what someone would pay for it if you sold it today. Write that number. Now ask, what would the activity be worth in 3 years if I harvested nothing from it for 3 years and directed every return back into its productive capacity? Not a precise calculation. A rough estimate based on what you have seen the activity produce when its returns are reinvested versus when they are harvested. The difference between the 3-year no harvest value and the current value, minus what you would have harvested in 3 years of normal harvesting, is the specific cost of harvesting in your specific situation. Most people who do this calculation find that the cost of harvesting is larger than they expected, and the calculation makes the practice of deferred harvesting specific and personal rather than abstract and theoretical. Specific and personal practices are sustained. Abstract and theoretical practices are not. Apply these 5 practices in whatever order makes the most sense for your current situation. Not all 5 simultaneously. That is more change than most people can sustain at once. One at a time, in the order of most immediate available application in your specific situation. Production before consumption is usually the most immediately applicable because every person with any income has an opportunity to hold consumption constant when income rises. The separation of production money from consumption money is usually the second most applicable because it requires only a structural change to how existing money is managed. The other 3 follow from the foundation the first 2 establish. The thing I want you to understand about why these 5 practices were kept in silence is not that silence was the primary purpose. The silence was in service of the sustainability of the practices. Practices described publicly attract scrutiny. Scrutiny attracts counter-arguments. Counter-arguments introduce doubt. Doubt erodes the specific kind of conviction that sustains a practice through the years before it has produced results visible enough to defend themselves. The silence protected the practices during the period when they were most vulnerable to being abandoned through the perfectly well-meaning persuasion of people who meant well but had never applied the practices themselves and, therefore, had no basis for the confidence with which they offered the counter-arguments. Once the practices had produced results, the silence was no longer necessary for protection. The results protected the practices. A demonstrated result requires no argument. It simply is. And the man who produced the result by applying the practice is in a position the man who abandoned the practice under the pressure of good-meaning argument is not. He has the result and the continuing practice. The other man has the counter-argument and the comfortable consumption that the counter-argument was used to justify. Apply these practices in silence until the results speak for themselves. Not silence from shame, not silence from fear of judgment. Silence from the specific understanding that a practice in its early stages is vulnerable to counter-argument in ways that a practice with demonstrated results is not, and that protecting the practice during its vulnerable stage is what allows it to reach the stage where its results make protection unnecessary. Listen to this every day until all 5 practices are operating in your life. Not just understood, operating. The understanding is the beginning. The operating, sustained through the silence that protects the practices in their early stages, is what produces the results. Now I want to go deeper into each of the 5 practices than I did in the initial description because the initial description gives you the what and the why, and what I want to give you now is the how in the specific daily form that makes each practice sustainable rather than theoretical. Production before consumption, at the daily practical level, requires one specific habit. Before any increase in income reaches your spending behavior, you must capture it. The mechanism for this varies, but the principle is identical across all mechanisms. When the income rises, identify the exact amount of the rise. Calculate a specific percentage of that rise, at minimum half and ideally more, and direct that specific percentage to a specific productive purpose before the consumption behavior has an opportunity to expand, to absorb it. Not later, before. The consumption behavior expands to absorb available income automatically and immediately. The only way to prevent that automatic expansion from capturing the entire increase is to redirect a portion before the consumption behavior has seen it. In practical terms, this means that when the raise takes effect, the redirection must be established in the same period, not the following month, not when you have had time to think about it. In the same period, with the same specificity, the productive purpose the redirection goes to does not need to be final or permanent. It can be a holding position while the best specific productive investment is identified, but the capture of the increase must happen before the spending behavior adjusts to include it. The reason most people fail at production before consumption is not that they lack intention. They have excellent intention. The raise arrives and they intend to invest a portion, and they fully expect to do so. But the specificity of the intention is missing. They intend to invest some portion without having identified the specific amount, the specific destination, and the specific mechanism for getting the money there before the spending absorbs it. And vague intention, no matter how genuine, is defeated by the automatic expansion of consumption behavior every time. Make it specific, a specific percentage, a specific destination, a specific mechanism that operates without requiring a decision in the moment. This is how the practice becomes sustainable rather than aspirational. The separation of production money from consumption money at the practical daily level requires a structural commitment made once that then operates without requiring repeated decisions. The structure can be as simple as a second set of accounts that only receives money designated for productive investment and from which no money is ever withdrawn for consumption purposes. The specific rule, no consumption withdrawals from the production account, must be treated as absolute rather than as a guideline. A guideline is abandoned under sufficient pressure. An absolute rule is not, because the moment it is treated as absolute, it stops requiring a decision under pressure. There is no decision to make. The rule applies. The difficulty of establishing the production account is in the period before the production account has generated any visible return. During this period, the production account is a place where money goes and nothing visible comes back. The consumption pool is smaller than it was before the separation, and the account that holds the production money appears to be doing nothing, while the consumption pool is producing the immediate rewards of daily life. This appearance is false, but it is convincing. And the false convincing appearance is what leads most people to eventually merge the pools again, often with the reasonable sounding justification that they will separate them again later when the circumstances are better. The circumstances are never better. The better circumstances is the state that the separation produces, not the state that precedes it. Maintain the separation through the period when it produces nothing visible, and the production account will eventually begin generating output. When the output arrives, the structural importance of the separation becomes self-evident. Before the output arrives, the structural importance of the separation can only be sustained by the understanding that the output will arrive if the separation is maintained, which is itself only sustainable if the understanding is specific and the rule is absolute. There was a period in the development of the company when I had set aside a specific sum for productive reinvestment into the operation, and the consumption demands of the life we were living at the time were greater than the consumption pool I had left for them. Clara came to me with specific needs that the consumption pool did not cover. The needs were real, and the shortfall was real, and the production account had the money that would have covered the shortfall. I did not move the money. We found another way to manage the consumption needs that did not draw from the production account. I am not describing this as heroic behavior. I am describing it as the specific moment that every person who implements the separation eventually faces, the moment when the consumption need is real and the production account has the money, and the rule of non-transfer is the only thing standing between the separation and the merger of the pools. How you respond to that moment determines whether the separation is a practice or merely a period of modified spending before the single pool structure reasserts itself. Paying yourself in productive capacity rather than in money at the practical level requires the specific identification of what productive capacity means in your situation. This is not an abstract concept. Productive capacity is anything that generates output without requiring a proportional increase in your time. A piece of equipment that does work without your presence. A system that delivers a product or service at scale without requiring your personal involvement in each instance. A trained person who extends your productive capacity beyond what you can produce alone. These are specific examples, and your situation will have its own specific versions. The identification of what constitutes productive capacity in your situation is the first step. Once identified, the commitment to acquiring more of it when returns arrive, rather than directing those returns to consumption, is the practice. This commitment, applied across multiple returns, is what produces the compounding that the one-time consumption of the returns would not. Here is the specific way to think about whether something qualifies as productive capacity in your situation. Ask this question: if I acquire this, will it produce output after I stop actively working on it? If yes, it is productive capacity. If the output requires your ongoing active work to continue, it is not productive capacity. It is simply a different form of work. Productive capacity generates output from previous investment of time or money, not from current active work. The distinction is the key to understanding what to acquire with returns rather than what to spend them on. The practice of building the system before the house is the one that I found most directly in conflict with the social norms of the world I was operating in. The expectation in business and professional circles was that success produced visible evidence of success: the size of the establishment, the quality of the materials, the scale of the personal circumstances. These visible evidences communicated to the world that the success was real and that the man was legitimate. The man who was succeeding without showing the visible signs of success was viewed with a specific kind of suspicion, as though the absence of visible wealth was evidence of something concealed or something failed. I understand why this norm exists. In a world where deception is possible and where the visible signs of success are one of the available signals about whether to trust a man with resources or a deal, the expectation of visible evidence is rational. But the rational expectation of others about how a successful man should live does not change the mathematics of what happens to the man who builds the house before the system and what happens to the man who builds the system before the house. The mathematics are not debatable. A man who builds the house from consumed income and then tries to build the system from what remains has less productive capacity available for system building than a man who builds the system from unconsumed income and then builds the house from the system's output. The sequence matters, and the sequence that runs against the social expectation is the sequence that produces the better long-term financial result. Ignore the social expectation about visible signs of success during the system building phase. Not permanently, during the system building phase. When the system is generating enough output that the house can be built from the output without constraining the system's further growth, the house can be built, and the visible signs of success can be as visible as you wish. But the house built at that point is built from the system rather than from consumed income, which means the house's requirements do not constrain the system, because the system is already large enough to sustain the house and continue growing. This is the condition that the reverse sequence, house before system, never reaches, because the house's requirements are always a constraint on the system that was trying to grow under them. The fifth practice, letting the work compound without knowing it, requires a specific adjustment to the way most people think about their own productive efforts. Most people evaluate their productive work by its immediate visible return. What did this produce today? What will it produce this month? What is the return on the effort invested in the last year? These are reasonable questions, and the answers are real information. But they are the wrong evaluation for work that is still in its compounding phase. Work in its compounding phase should be evaluated by a different question. Not what did this produce in the period I can measure, but what is this becoming that I cannot yet measure? The productive work that is compounding has a visible present return and an invisible future return that is much larger than the visible present return. Evaluating the work by its present return alone is evaluating the tree by the fruit on the branches today, rather than by the root system and the annual growth rate, which together determine what the tree will produce at full maturity. A man named Lawrence, who came to me in the years when the company was operating at full production scale, had a concern about a productive activity he had built that was generating modest returns. He felt the returns were not large enough to justify continuing. He was thinking about harvesting what the activity was worth and directing the proceeds elsewhere. I asked him one question, not about the current returns, about the annual growth rate of the activity's productive capacity in the past 3 years. He did not know the answer precisely, but his rough answer suggested the productive capacity had been growing at a rate that, if continued, would produce a very different scale of returns in 3 more years. The current returns were the early fruit on a tree with a root system that was growing faster than the fruit yet suggested. Lawrence did not harvest the activity. 3 years later, the returns were larger than the harvest would have produced. He told me that the question about the growth rate of the productive capacity, rather than the level of the current returns, was the most useful reorientation of his thinking about the activity he had experienced. He had been evaluating the tree by the fruit rather than by the root system. Evaluate your productive work by its growth rate as well as its current returns. The growth rate of the productive capacity is the signal about what the work is becoming. The current returns are the signal about where it is today. Both matter. But the man who abandons a productive activity because the current returns are modest without looking at the growth rate of the productive capacity is making a decision with half the relevant information. These 5 practices together produce something that none of them produces individually. They produce a structure in which productive capacity grows continuously. Consumption remains proportional to production rather than leading it. The compounding of returns is not interrupted by harvest at the wrong moment. And the system eventually generates more than the house requires. This structure is financial independence in its specific mechanical form, not a large sum of money held as money. A productive system generating output larger than consumption requires, operated by someone whose house does not constrain the system's growth because the house was built after the system rather than before it. The total of these 5 practices, applied together over years, is not a formula for becoming wealthy in the abstract. It is a specific structure that produces independence, which is different from wealth. Wealth is a large amount of resources. Independence is a condition in which the resources are self-generating, and the conditions of your daily life do not depend on the continuation of any specific income source. Wealth without independence is a large amount that can be consumed. Independence is a system that generates what consumption requires without depending on a specific income to do it. Build toward independence rather than toward wealth. The practices I have described build independence. They may produce what looks like wealth from the outside. From the inside, what they produce is the specific condition of a man whose productive capacity generates the output his life requires, whose house does not constrain the system, and whose decisions about work are free rather than constrained by the house's requirements. That condition is what I built, not through luck or exceptional talent. Through 5 specific practices applied in silence through the years when they were producing invisible compounding rather than visible results, and held through the years when the invisible compounding was producing visible results that the silent practices had made possible. The practices are yours. Apply them in the order that makes the most sense for your current situation. Keep them private until the results speak for themselves. And listen to this again until the practices are operating rather than merely understood. The last thing I want to leave you with is not a sixth practice. It is an honest account of what the 5 practices cost personally, because anyone who describes financial practices without describing their real human cost is giving you something that sounds easier than it is and sets you up for failure when the cost becomes visible. The cost of production before consumption is visible and immediate. The people in your life who see your income rising without your circumstances rising will ask questions. The questions will be gentle at first and more pointed later. The implication behind the most pointed versions of the question is that you are either failing to enjoy what you have earned or failing to recognize that you have earned it. Neither implication is comfortable. Both will arrive. The practice is held through them by the knowledge that the discomfort is the gap between the current moment and the result, and that the result is coming in the direction of the arrow if you hold the arrow's direction. The cost of the production-consumption separation is the feeling of scarcity that the smaller consumption pool produces in the period before the production pool generates visible returns. This feeling is not rational, because the total resources have not changed, but it is real. And the real feeling of having less available for daily use, even when the reason for that feeling is a structural decision rather than an actual shortage, produces a specific kind of daily discomfort that is easy to resolve and hard to keep resolved. The resolution is to merge the pools. The resolution feels immediate and rational. The cost of the resolution is the practice itself. The cost of paying yourself in productive capacity rather than money is the cost that other people bear more than you do. Your shareholders, your partners, the people who expected returns in the form they are accustomed to receiving them. Managing those expectations, maintaining the relationships that sustain the productive activity while directing more returns into productive capacity than those relationships expect, is genuinely difficult work. It is not the kind of work that is visible as work. It looks like negotiation. It looks like communication. But the sustained management of relationships under the pressure of mismatched expectations is as costly in its own way as any other kind of difficult work. The cost of building the system before the house I have already described honestly. Clara's patience was real, and I was not always adequate in acknowledging it. The years of living more modestly than our resources could have permitted were years that affected both of us, not just me. The practice was right. The cost was borne partly by the person whose choice it was not. I do not think there is a clean answer to this tension. The man who builds the system before the house is making a choice that affects the people who share the house without them having made the choice. All I can say is that the house we eventually built from the system's output was better than the house we could have built from consumed income, and that the system continued growing after the house was built, rather than being constrained by the house's requirements. Whether that outcome justified the years of shared modesty is a question that each person who shares a life with a system builder will answer differently. The cost of letting the work compound without harvesting it is the specific cost of watching others harvest their work while you do not, and feeling the social pressure of the comparison in the specific way I described earlier. Men around you will take the returns from their productive work and build the visible markers of success that the social world expects. Your comparable productive work will be generating comparable returns that you are not harvesting, which means from the outside it will look as though your productive work is generating less than theirs. The appearance is false, but it is consistent, and the consistency of a false appearance over years has its own weight. I held through all 5 of these costs because the direction was clear, and the evidence from the building confirmed the direction was right, not because I was certain about the outcome. No one is certain about outcomes in conditions that contain genuine uncertainty. But because the specific evidence available at each stage of the building, the demonstrated results that the practices had already produced, made continuing more rational than stopping, and the continuing produced the next stage of evidence that made further continuing more rational than stopping, in a sequence that extended until the system was large enough to make the house and the harvest and the visible success available from the system's output rather than from consumed income. That sequence is available to you, not as inspiration, as a specific structure with 5 specific practices that produce the sequence when applied. Start with the one that is most immediately applicable in your current situation. Apply it with the specificity that makes it a practice rather than an intention. Keep it in silence until the results defend it. And come back to this every day until all five are operating in your life rather than merely understood. The practices work. I am the evidence. Subscribe and come back for what's next.